All right, so the question was the following. Okay? The question was the following. You were asking about hedge funds or managed funds?
Hedge fund.
Hedge funds. Hedge funds are supposed to be very safe. That's only on paper, and that's only a marketing lie. Originally, back in the old days when hedge funds were established, the early hedge funds, the original hedge funds maintained a strategy which is known as, let me write it out, market neutral. Market neutral. A market neutral position is a position where the fund's performance or the performance of the portfolio does not depend on the movement of the market. A different way of saying it is that the beta of the portfolio is 0. In other words, the market can go up, the portfolio isn't going to go up and isn't going to go down. The portfolio is neutral to the market. The market can crash 10%, but your portfolio is still going to be okay. So, how did they maintain that? Very simple. They're going to have long some stocks AA, B, C, C, and D. So they're going to have 4 stocks which they're long, and they're going to have a few stocks which they're short. X, Y, Z, Z. So overall market or the total of the betas on the longs will be offset by the negative beta of the shorts. Okay? So whether the market went up or went down did not affect the performance of the market neutral. They went long these because they believe that these will be, or these are overvalued, and that these, where they're long, will outperform the market. So they'll be gaining on their longs because they'll do better than the market. And they're shorting these. Oh, these longs are undervalued. My mistake. These are under. The longs are undervalued, and they expect the longs to outperform the market. The shorts are overvalued, and they expect to underperform the market. So, if the hedge fund is correct, they'll be gaining on each of the longs relative to the market, and they'll be gaining on each of the shorts relative to the market. And if the market moves up, the market moves will cancel. So we say, investments, that all they're trying to do is to capture the alpha. The alpha represents the the undervaluation, the overperformance above and beyond the effect of the market, above and beyond the beta. Same thing here. So all they're trying to do is capture the alpha. If it's undervaluation, you go long, and if it's overvaluation, you go short. And if that's the case, because you're market neutral, you have very little market risk. And when the markets will go down 5 or 10%, hedge funds will do very well. And when the market goes up 5 or 10%, they'll still do very well. And the idea is that you were market hedged. You were hedging the overall movement of the market. So that was the original idea and the original extension of the hedge fund. And the original idea was that you could short certain stocks which mutual funds could not do. Well, that idea early on was a very good, very genuine idea, which soon after got abandoned. It got abandoned for a simple reason. You don't have very many stocks which are undervalued, so you can go long. You don't have very many stocks which are overvalued to go short. And as soon as you get 3, 5, or 10 funds, and they start doing the same thing, suddenly all of these profit opportunities disappear. In other words, there aren't very many opportunities for hedge funds to invest in what we call mispriced assets. So from there, the only way to make more profit was very simple. You had to take more risk. And hedge funds began the race for higher and higher and higher risks. And of course, one of the ways is you do more leverage. You leverage up. One of the other ways is you try to what's called quasi arbitrage. So it's not exactly a perfect arbitrage, but you think you got an arbitrage opportunity. So the other way is, oh, you start doing more futures, you start doing more options and all the other things. So again, the futures and options are yet another mechanism to add leverage to your portfolio and yet another way to increase or boost the overall risk. And if you boost the overall risk, what's the idea of the hedge fund? The idea of the hedge fund is, hey, I just want to be right for 2 years. I want to make some money for 2 years if I'm lucky, right? And if I'm making 2% out of the total money or 20% out of the profit, if I get a big fund, all I need is 2 good years and I'm going to be a multi-millionaire and I can retire in 2 years. And if I am not lucky, the fund's going to close and I'm going to open another fund somewhere else and hope to get luckier over there. And that's how they were doing. You just take a lot of risk and you hope that sooner or later risk will work out in your favor and you're going to be rich. That's the whole idea for the thousands of funds. Of course, if you got 1,000 hedge funds, 20, 30 or 50 of those 1,000 funds will be really good. They will be run by extraordinarily smart people. These people will have huge libraries which they will have read. They will understand the history. Come on, guys. All right, separate, okay? All right, a little bit more, okay? We got 10 more minutes, okay? I'm sure you can survive 10 minutes, right? Without talking, right? Okay, so hedge funds early on had a very good idea where they were market neutral, and later on the whole idea got degenerate. And later on the idea was you take more risk and more risk and more risk. If you lose money, it's the investor's money, not your own. So you don't get other people's money. But if you make money, you're rich. So if you win, I win. If I lose, you lose. Okay? So that's the asymmetric payoff with hedge funds, okay? So they are extremely risky. The other reason is they don't really have to tell you what they do. You don't have to really know. You just hope that they're good and you just hope that they're honest with you, okay? Because Madoff's fund was something like that, but it turned out to be a fraud, turned out to be a lie. All right, few more minutes, 8 more minutes, right? So what are the costs? When you trade in futures, there are certain costs. And the first main cost is commissions. You buy, you got a commission. You sell, you got a commission. You want to take a delivery, there is a delivery cost. I already explained the commissions in futures are usually round trip commission. You pay when you buy, when you open the position. Maybe you sell first, you sell short, and you pay both for the opening of the position and then for the closeout of the position. And the other cost is the bid-ask spread. The bid-ask spread is the difference between the bid and the ask. So on gold, the bid-ask spread could be literally 10 or 20 cents. 20 cents. So it's not a big deal, okay? So it's going to be well, 1,212.30, 1,212.50. It's a small. So a very simple correlation. The more liquid the contract is, the smaller is the bid-ask spread. In other words, the bid-ask spread is a good indicator of the liquidity of the market. The more liquid it is, the smaller the bid-ask spread. Commissions. When I was trading, commissions were literally $7.50 on a round trip. Sometimes, for some others, will be $15 on a round trip to buy and to sell, okay? So, $7 or $15 per contract is like nothing. It is very, very, very symbolic. So I could trade a few times every day and the trading cost wouldn't bother me too much. Now, if the trading cost is $50 or $100, that could be a lot. Now, when I was in Bahrain, I went to try to a couple of banks and I wanted to open a futures trading account. That would be like 5-6 years ago, 2009, 2010, 4 or 5 years ago. Turns out that in half the banks and financial institutions, when I walk in and ask about a futures contract, they don't know what it is. They've never heard. They don't understand the futures. They don't understand options. I'm speaking a foreign language to them, which they don't understand. They have no idea what I'm talking about. They keep calling other people, They got a brokerage. They keep calling the brokerage a division of the bank, of the financial institution. The brokerage division has no idea what I'm talking about, okay? So when I finally found a company which will deal with futures and options, and they had me to fill out these huge sheets and open the account and everything else and all the other things, and they wasted 2 hours of my time and I wasted 2 hours of their time. I discovered that the commission for buying a futures contract was $100 per contract. So I want to buy $100. I want to sell $100. Well, there's no way I can make money this way. The cost is extraordinarily high. So the answer was, thank you for wasting my time. I should go and try to find somebody else. So eventually, I had to open an account with American brokerage, which was in Chicago, Mann Financial, and that Mann Financial company was a company which was directly a brokerage at the exchange, so they were giving as close to the exchanges as possible. So we're talking about $7, $8, $12, $15 commissions, which was very, 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 very good. Okay, you put it on a computer, everything's quick, it takes a second or two, you can immediately see your execution, your statement. It was fantastic until Mann Financial went bankrupt. And with it, all the money in my account, which at that time I was on an unlucky streak, I had barely $2,000 left, so the $2,000, my whole account disappeared, meaning all the customers' accounts disappeared. Some people will have 20,000, some people have 500,000 or 2 million or 5 million accounts, and all of these disappeared. These were, of course, insured by the US government, SIPC, so there was an investor's insurance, but nobody ever saw any of their money back. It is yet another risk. You invest in the financial markets, the exchange is okay, but your broker goes bankrupt. Right? Well, the broker is not supposed to go bankrupt because the broker is also supposed to buy and sell. Okay? And the broker is not supposed to trade with the customer's money. Alright? The customer's money is called our segregated, okay, and they can't touch. But not only they touch, they actually were actively using them to speculate on other futures and options market, and they lost the money. And then, of course, these people are too big to prosecute, you know. The big boss there was John Corzine, who was former CEO of Goldman Sachs and a senator or whatever. He's a politician. You know, the money just vanished, disappeared. We're talking about billions of dollars, which is yet another risk. You're hedging, you're trading, you're executing everything else, and then your whole brokerage account just disappears because a broker goes bankrupt, which is yet another risk. All right, so bid-ask spread is usually very, very small. 3 more minutes. All right, regulatory, you need to know where you're trading and who the regulator is. CFTC is for the US, Financial Services Authority. FSA is for the UK. For Japan is called again Financial Services Agency is for the Japan. So you need to know what the regulator is. In other words, where you're trading, where the exchange is, and who is the regulator of the exchange, and what are some of the goals. Well, you want to have public information. So, in other words, exchanges have to be open about trading. You want to have authorized, you know, so the regulator will authorize and license the contract. So, yes, you can trade this, you can trade this, you can trade this. In other words, you can check every single contract with the regulator. So, you can essentially find in Thailand what's your regulator, and at the regulator you can find all approved derivative contracts for trading. Okay? Second, just because they're approved doesn't mean that they will be trading. Okay? They might not be trading. Okay? Because they might not be buyers. They might not be submitted. Okay? Contract approval, and they watch for market surveillance. They watch if someone is manipulating the market, if there is fraud, and all the other things which they're supposed to do. Regulators or someone else will arbitrate disputes when there is a problem between a buyer and a seller, or a customer and a broker, or between two entities, and there is a dispute. Someone's got to decide. Well, in the United States, they say, oh, we don't want to involve the courts. We want to involve an institution, an arbiter, which will protect our interests. So instead of going to the court where the little customer has a chance, the financial institutions and the brokers organize themselves. They appoint their own arbiter, okay? And when there is arbitrage, okay, this is a different type of arbitrage. In other words, the institution has to judge. They almost always judge in favor of the big financial institution and usually up against the little guy, okay? Everything is made or stacked against the little guy and in favor of big banks and big financial institutions. Foreign markets are generally unregulated, or they are regulated only indirectly. If, for example, you got a commercial bank and commercial banks get into some forward contracts, the regulator will be regulating the bank itself, and not in any way you're going to be regulating these forward contracts. So forward contracts enjoy certain degree of not being regulated. This is the main reason why swaps early on started and took off, because swaps were early on unregulated and they could tailor them and design them and whatnot. And if they're unregulated, a lot of banks and financial institutions could engage in these swaps and they did not have to report them. Remember, this is from last time, good off-balance sheet activity. Until the Bank of International Settlement said, wait a minute, these off-balance sheet activities are very risky, and began to force them to report. Let's see what else we got and we're finished. Okay, some summary and whatnot. Taxation, that's US, we're not going to cover. You don't have to learn. These are the exchanges in the different countries. So you can see the different countries. Do they have Thailand? They don't have Thailand. And these are the monthly seats on the exchange. You already looked at it. Nothing really interested. This is how a transaction occurs. The buyer goes to the buyer's broker, then they go to the commission broker to go to the exchange. And this is the seller side. When the trade occurs, it clears through the clearing house. And this is the daily settlement example. It's very difficult with a bond. You say 97, 27, 32, too much. So it's a lot easier to do it with crude oil or to do it with gold because the contract is a round number. You don't have these fractions and all of these complications. I think this is the last one. Yes, that's the last one. All right.